I'm often asked, what is the difference between a reverse mortgage line of credit and a home equity line of credit? So I'm going to go through the major differences with you today. The first one being age. A HECM reverse mortgage has a minimum age of 62 years or older, whereas a home equity line of credit, of course, has no age requirements. For loan amount, the reverse mortgage determines your loan amount based off three things: your age, the older you are, the more money you're going to get; the rate, the lower the interest rate is, the more money you can receive; and the value of your home. Whereas a home equity line of credit, most lenders are probably going to use 80 to 85% loan to value. You may be able to find a lender out there that goes up to 90%, but that's going to be very aggressive. Qualifications: the reverse mortgage has no minimum credit score. So your credit score is not going to determine whether or not you qualify. They do look at your payment history, but the credit scores, if you have a low credit score, that's not going to disqualify you for this loan. For income, they look at what we call residual income. So all this looks at is how much money you have coming in versus your monthly obligations, your taxes, your insurance, homeowners association dues, car payments, credit card payments, and then at the end of the day, how much money do you have left? And that's what we look at to meet residual income. Whereas the home equity line of credit will have a minimum credit score, probably somewhere around 680, and a maximum debt to income ratio. And that's probably going to be somewhere right around 43%. Debt to income ratio is how much money you have going out versus how much money you have coming in. Next, payments. We talked about this already, but I just want to make sure you understand that there is no required principal or interest payment with a reverse mortgage. You can make payments if you want to, but you're not required to do so. Whereas a home equity line of credit, you are going to have a required minimum payment, and most of the time these minimum payments are interest only. So you won't be paying down any principal with your minimum payment with a home equity line of credit. How are the funds set up? Well, this is probably the biggest advantage of the reverse mortgage over the home equity line of credit. The funds that you have access to, the unused funds, will grow at the interest rate plus 0.5%. And that's guaranteed to grow. It doesn't matter what happens to your home's value, your funds, your unused funds will continue to grow at the interest rate plus 0.5%. Plus, because it is an FHA insured loan, it's secure and it's guaranteed. As long as you're meeting the obligations of your loan, which is staying in the property as your primary residence, paying your taxes, your insurance, homeowners association dues if applicable, and maintaining the property, this loan can never be frozen or taken away from you. You will always have access to your line of credit. Whereas a home equity line of credit, that's going to be determined by the lender. Most lenders require that you requalify every 10 years. And then if you remember back in 2008, 2009 timeframe, when we're going through the Great Recession, a lot of lenders actually came in and froze people's line of credits. So they're not guaranteed to have access to it. So big advantage for the reverse mortgage when it comes to how the funds, how you can access your funds. Finally, the reverse mortgage, in my opinion, wasn't designed as a short-term loan, whereas a home equity line of credit could be used in a short-term situation. For example, let's say you're looking to sell your home and you want to do some repairs before you put the home on the market. A home equity line of credit is going to be a better option. You can get into a home equity line of credit fairly quickly and have access to money in a short period of time. If you're looking at a home equity line of credit or a reverse mortgage and want to get more information on which one's better for you, give my office a call.